What if I gave you $100,000 20 years ago? Would you have been better off investing it in the stock market or buying real estate? It's one of the biggest debates in personal finance. Some people swear property is the safest path to wealth. Others believe stocks quietly outperform over the long run. Today, we're going to compare both investments using real-world historical performance, look at what happened over the last 20 years, and then use those lessons to predict what might happen over the next 20. The results may surprise you. This matters because choosing the wrong investment could cost you hundreds of thousands of dollars over your lifetime. For most Australians, these are the two biggest wealth-building opportunities available. Real estate has created enormous wealth for many Australians through rising property values and leverage. At the same time, the stock market has quietly delivered strong returns with less hassle and lower upfront costs. The problem is that many people choose one side without understanding the trade-offs. By the end of this video, you'll know how a $100,000 investment performed in stocks versus real estate over the last 20 years, the advantages and disadvantages of each investment, which option is likely to perform better going forward, and whether you should choose stocks, property, or a combination of both. Let's start with the numbers. The $100,000 challenge. Imagine it's 2006. You have $100,000 ready to invest. You have two choices. Option 1, invest the entire amount into a broad stock market index fund. Option 2, use the money as a deposit on an investment property. Let's see what happened. If you invested $100,000 into a diversified stock market index and reinvested all dividends, your money would have grown significantly over the last 20 years. Historically, Australian and international stock markets have returned roughly 8 to 10% per year over long periods. Using a 9% annual return, $100,000 would grow to approximately $560,000 after 20 years. That's over 5 times your original investment. And remember, this growth happened without dealing with tenants, maintenance issues, insurance claims, or property repairs. You simply invested and let compounding do the work. This is the biggest advantage of stocks. They are passive. You can literally build wealth while spending only a few minutes each year managing your portfolio. But stocks aren't perfect. The journey can be stressful. During the global financial crisis, many investors saw their portfolios fall by more than 40%. During the COVID crash, markets dropped rapidly again. To achieve those long-term returns, you needed the discipline to stay invested during periods of panic. Scenario 2. Investing in real estate. Now let's look at property. Instead of investing the entire $100,000, you use it as a deposit on a $500,000 investment property. This is where things get interesting. Property investors rarely buy with cash. They use leverage. In this example, your $100,000 controls a $500,000 asset. Over the last 20 years, Australian property values have generally increased significantly. Assume that property doubles in value over that period. A $500,000 property becomes worth around $1 million. At first glance, that looks similar to stocks. But here's the key difference. You only invested $100,000. The gain wasn't calculated on your deposit. It was calculated on the entire property value. That leverage magnifies returns. In addition, you've likely received rental income throughout the ownership period. Those rental payments helped cover mortgage repayments and expenses. This is why so many Australians have become wealthy through property. Leverage can accelerate wealth creation. But leverage cuts both ways. If property prices fall, losses are magnified too. You also face ongoing costs. There are maintenance expenses, council rates, insurance, property management fees, vacancy periods, unexpected repairs. And unlike stocks, selling a property can take months and cost tens of thousands of dollars. Property is far less liquid. So which investment won? The answer is frustrating. It depends. If we're comparing a simple $100,000 investment with no borrowing, stocks likely come out ahead. The power of compounding, dividends, and low costs make them incredibly effective. But if we're comparing leveraged property against unleveraged stocks, property often appears to generate larger gains because you're controlling a much larger asset. The reality is that many property investors are actually using leverage as their secret weapon, not necessarily achieving superior asset performance. In other words, they aren't just investing in property, they're borrowing heavily to amplify returns. That's an important distinction. What can the last 20 years teach us about the next 20 years? This is where things get interesting. Many investors assume the next 20 years will look exactly like the last 20 years. History suggests that's unlikely. Australian property prices have experienced extraordinary growth over recent decades, but housing affordability is becoming a major challenge. Higher prices mean future growth rates may be lower than what previous generations experienced.
At the same time, stock markets continue to benefit from innovation, technology, productivity improvements, and global economic growth. Companies are constantly creating new products, services, and industries. 20 years ago, many of today's largest companies barely existed in their current form. The stock market has a built-in ability to adapt to the future. That doesn't mean stocks will definitely outperform property. No one knows. But many analysts believe future returns from both asset classes could be lower than the exceptional returns seen in the past. The lesson isn't to chase whatever performed best previously. The lesson is to own quality assets and stay invested for the long term. The real answer most people miss. The most successful investors often don't choose one or the other. They own both. Property provides leverage and rental income. Stocks provide diversification, liquidity, and passive growth. Together, they can create a more balanced portfolio. Instead of asking whether stocks or real estate is better, a better question might be, how can I use both to build wealth? Because ultimately, consistency matters more than choosing the perfect asset. The person who regularly invests for 20 years will usually outperform the person who spends 20 years debating which investment is superior. The stocks versus real estate debate will probably never end. Both have created millionaires. Both have risks. And both can play an important role in building long-term wealth. If you found this comparison useful, make sure you subscribe for more Australian investing, personal finance, and wealth-building content. And let me know in the comments, if you had $100,000 to invest today, would you choose stocks, real estate, or a combination of both? Thanks for watching, and I'll see you in the next video.